Analytics, creator of the demark indicators, and has been a special consultant to Stephen A. Cohen of Point72 Asset Management for over 22 years. He has spent more than 40 years developing trading and teaching techniques for institutional professionals around the world and continues to be actively involved in the financial markets. Tom, thank you for joining us today.
Hey guys, thank you, Stephen. This is Rod Bentley. I'm a member of the demark analytics team. I just wanted to get things rolling here before we get Tom online. Thank you all for joining us here today. This is a fantastic setup that Money Show has set up, and I just want to run through a few housekeeping items before we dive into some really intense topics. So first off, there's all of the content, everything that we discuss here today should be treated as if it were educational. There's no trade recommendations or advice, no recordings of any type, and so just once again, what we discuss today is only to discuss the educational aspects of the demark indicators. Joining us here today, Tom DeMark, myself, and then Tom Schneider, Bill Heron, and Christopher Reed. We're all fortunate members of the demark analytics team, and the charts that you're going to see today are the symbolic charts, and these help make you informed decisions. It's charting that's at a facelift done right. These are time-tested demark timing analytics, and you can find this is where we're pulling all the charts at today. You'll notice that these are institutional grade web-based financial platform, and it's our demark indicators on the web. And the beauty of this thing is using cutting-edge technology, cloud-based processing, so it's really fast, mobile devices, fantastic analysis on demark vetted code. It's very important. We're going to circle back on that here shortly. So Tom has spent half a century. In fact, Tom was awarded the Lifetime Achievement Award from the MTA for his work. Most don't know that Tom's actually been considered for a Nobel Prize. Bloomberg several years ago were asked by two gentlemen from Europe for all the demark information on the Bloomberg machine. As you know, that's institutional platform that Tom put his work on, and they said that he was being considered for and it may take up to a decade. I mean, even longer. The requirement for that is that the person has to be alive to receive it. So, anyways, Tom has had the pleasure of, absolute incredible career. Anybody that has followed his career knows that he has traded with advised some of the top traders in the world. With that background in mind, all of Tom's work is original. He really pioneered a new method for analyzing. It's been called the mathematics, the language of the markets. And that's what he's done through an obsessive reverse engineering of data sets. This is the most recent public appearance that Tom made on CNBC. Now Kramer went on and on Bloomberg as well. This is Kramer. If you could pull up Wiki and take a look, and even pull up this link. I mean, he was just it said nothing but accolades. When he left Goldman Sachs, Kramer was told that this is the man to follow, Tom DeMark. Tom had another just stellar call. It was just absolute. This is commonplace. But when he goes public, it's really nice because he shares all this with everyone. And what you'll see on this forecast was Kramer called Tom a titan of trading, making godlike forecasts. It was really impressive. You'll see on the chart there where Kramer's pointing to the 13s, probably Tom's most famous work, which is sequential and combo. You'll notice 9s and 13s. By the way, the Bitcoin community has made this their staple. I mean, because his work is absolutely uncanny at times. You can see these retracements. Now, Kramer actually apologized during this. Go ahead and pull it up. You can pull up the YouTube video on CNBC, and you can hear Kramer saying, "I apologize. Tom said that the low was in. He nailed it." He said that, he goes, "We were going to have an 11% rally." And sure enough, the day that he showcased Tom's work, they had an 11% move. Kramer apologized that he couldn't get it on the day before when he had all the content, all of the analysis that Tom had done. You can see the 13 at the high, the 13 at the low, right at what's called absolute retracement. These are all tools that are available on the platforms that we've showcased earlier, everything from CQG Bloomberg to Symbolic. All of these tools, there's no hidden secret sauce. I mean, Tom uses what he created. Just like in 2011, I remember we were in Europe. I had the pleasure of traveling around the world with Tom, and we were speaking. It was a 10-hour session. People had cut their vacation early, and it was August 16th, which is right after the low of the steep decline. And a reporter asked Tom during one of the session breaks what he thought the market was going to do, and he said, the market's going to make new lows. That's not dissimilar to what happened here. I mean, Tom made a forecast, and he said, and it was after a 5-day rally, and 6 weeks had gone by, asked if they wanted to revise the forecast. Tom said, no, it's math. Then he doubled down. Kramer even talks about this. He said he doubled down and said this. He made a forecast within 1 point of the S&P, and then he said we're going to run 20%, and exactly what happened. And so that market low that he nailed is online. That was done real time. Occasionally, Tom comes in and he goes. The news media approaches him and says, "Hey, Tom, what do you think about this?" And so he'll take a snapshot and share with users. So this is the volatility index. Remember the 9s and 13s. Just remember that for now. I'm going to show you several charts in rapid succession, so that way you can get a sense for the uncanny accuracy of how well this price exhaustion model works.
Unlike most technicians, we're not technicians. We're I guess, identify ourselves as market timers. We try to identify trends when they're about to exhaust rather than react to a move in the market. We want to anticipate. And as you can see here, the VIX is designed to do that as well. Just by its very nature, it's designed to anticipate inflection points where the market's about to turn either upside or downside. Into that peak that we had into the peak we had at the bottom, I should say, in the peak in VIX and the bottom in the stock market. 1 week prior to the bottom, the VIX recorded what was called a combo. That's a cousin to the sequential 13. At the same time, it also recorded a sequential 13 the same day on the peak day. And because the VIX is designed, I mean, at least it's been responsive about 3 to 5 days after or before the market is likely to turn, it speaks and then the market responds. Just recently, last Friday, in fact, we recorded a 13, which is the reverse of the converse of what we recorded at the top of VIX. We recorded a 13. It's a combo 13, but there's one version. We're waiting for another version, and we're looking possibly for, I mean, it's not a recommendation, but this is from our own experience. We could go down one more time and make a low VIX, which would be a higher high in the stock market. But you can at least get an appreciation for what we're doing. It's unlike the approach anybody else uses. It's as we get closer to a top, the buyers diminish, and as a result, the sellers take over at the top just after a peak. And conversely, at a bottom, the buyers diminish. I mean, the sellers diminish, and the buyers start coming into the market, and markets reverse. Just by our very nature and our background, starting in the institutional area, we had to anticipate those market turns because we were prepared to take sizable positions in the market. So we didn't want to operate like an individual trader and buy after a bottom and sell after a top. So we're taking more risk in the sense that the media and the people, most traders are going to have an outlook on the market that's going to be 180 degrees the opposite. But that's just the way we've been built for the last 40 years, and that's the way we operate.
Yeah, there's one trader called it, he goes, it's the art of catching a falling dagger. He said, you're really a lone wolf. When you're following demark analysis, you're against the trend. And that's exactly what Tom's work does, is it just simply alerts you to a potential price exhaustion point. And what do I mean by exhaustion? When you see those blue numbers on the price bars, when they're above the price bars, that simply says, okay, what we're going to do is we're going to start counting for non-consecutive occurrences. When we reach a 13, we're at a potential price exhaustion area. What happens is that, as Tom mentioned, that as the market rallies, the indicators become less enchanted with the market. As the market declines, as we approach a 13, we're ideally where all the sellers have sold, and the ultimate is that we have exhaustion of sellers, not sophisticated buyers coming in the market, rather than a lack of sellers. And same thing, the inverse. I'm going to flip through a few more charts here, and we'll get into some details. This is sequential. Sequential is a cousin to TD Combo. They both arrive at the same conclusion, which is 13. And they both share two common ideas, which was the 9 setup, which is the blue numbers on the chart. Those are, you'll notice that those are consecutive price bars. Well, the beauty of this is that once that sets the tone, the direction of where we're going to start counting the red or the magenta numbers, as the case may be, those are non-consecutive occurrences.
Well, 9s typically identify short-term moves in the market. They try to anticipate tops and bottoms of a short-term nature. And it all depends upon something, a relationship between the setup and a contra TDST level, which we'll discuss afterwards. But if you're above the TDST level and you have a sell setup, then you probably could expect us to pull 13. 13s are more momentous. They're meaningful changes in the trend in the market. We were surprised back about 7-8 years ago. One of the partners in the company was a major sponsor or believer in Bitcoin and cryptocurrencies, and we never really applied our work because we didn't have the data. About 3-4 years ago, we were able to get a number of different exchanged cryptocurrency data, and we were surprised to see that the 9s and 13s worked on those markets as well. It seems to work on just about every market, or just about everything that has a trend, whether it's beer production or inventories or unemployment numbers. It seems to have a good record of success in identifying those trends as well. But regardless, we started seeing in the last 3 years, we do alerts on the different media, and we'll see the Mark 9 or TD setup, and a lot of the people who follow the cryptocurrencies and Bitcoin in particular will have used the 9s to identify tops and bottoms in the Bitcoin and cryptocurrency markets, and apparently it's been successful. We know that last week there was a 13 on Friday or Saturday, and one of our users, Phil by name of Thornton, identified that top, and the Bitcoin market sold off by about, I think, $1,200. So it does have a good success record, and we'll show you a chart that we've been following for the past 3-4 years. We've been on TV to announce a number of the turns, and they've been, fortunately, some of them been to the exact day of the top and bottom, just using the approach that we're going to share with you today. So the next chart is just the chart of the Dow Jones Industrial Average. This is when we happened to be on TV with Bloomberg the day of the low, prior to the open of the market, and we announced that the market was about to record a 13, and we expected the Dow Jones Industrial Average to make a low about 18,200 approximately, and this is before the market opened. And fortunately, the market did go to that level in overnight trading, fell short by about 103 points or 100 points in the day session. But we were able to project the downside by taking the highest price prior to the decline, which was the all-time high in the Dow Jones average. And sometimes we use the high price, sometimes we use the high day close, and sometimes we may use the next day's close, depending upon if there's a price gap. But when you make forecasts this long-term in advance, we just multiply 61.8%, which is the Fibonacci number, times the high price. And that's how we arrived at our projection. We had a similar downside projection in the S&P, which was fulfilled in the overnight trading, but was not fulfilled in day trading. So that one is still outstanding. So if you go to the next chart, you can see that there are 13s on tops and bottoms. In this case, this is the Dow Jones. The prior one was combo. This one is sequential. We only recorded a 12. So that's still outstanding. We never did record the 13. And that's what our status is currently. The next one is the S&P index. We use retracements just like everyone else does, but our approach is quite a bit different. Everything we do is mechanical, and everything we do is in the sense that it's permanent. If we show a retracement level or we show a 9 or a 13 on a chart, it's there permanently. We don't, like some technicians, I think, have a tendency to draw trend lines and make calculations with a pencil with a big eraser, and they seem to overlook or just forget about the bad levels that they projected. And we maintain everything. As you can see on this particular chart, the S&P cash went up to a retracement level, which was 62% approximately. And we knew that was going to 62% or should go to 62% once that red line, can you show it on here with a cursor? Once that red line was exceeded right here, and that was confirmed. When that line stopped moving forward, we knew it was probably going to the next level. And that's where we went 3 weeks ago, and that's where we went the prior 3 days. If we go forward, that's relative retracement. We've got the one where we made the projection downside was called absolute retracement, and we also have a retracement arc, which incorporates both time and price. This is something we didn't expect, but obviously the QQQ and the NASDAQ portion of the market has shown great relative strength, and we broke the first retracement level. The line suspended in early April, which told us we're probably going to the next level, which at the end of April we had exceeded, and it was confirmed. And now we got an upside projection, not that it's going to be hit, or not that it'll be hit within the next week or whatever, but that's the projection that we've had based upon this indicator, relative retracement, which is back up to the high days close, which is the high close that we recorded in February 23rd. So that's only the NASDAQ related markets have that upside potential. As you can see, that prior chart we had with the SPX, it was not, there was no solid line there. If a solid line does appear after it's been qualified and confirmed, then we do have the potential to go quite a bit higher. This is the QQQ, same thing. QQQ, NASDAQ Composite, and the NDX all have exceeded and qualified and confirmed their retracement breaks. And like I said, this is not advice, but this is the potential. As you can see here, here's the NASDAQ Composite based upon combo. We're at a 10. We recorded the 9, as you can see, the cursor's there. The 9 right there, which is a setup. And you can see how the market responded. You had a 2-day pullback. You're above the TDST level, so we knew it was just a short-term pullback. And now, hopefully, we go to 13. We may not, but that's our goal. We had a 9 into the bottom low in March, and it's perfected. What we look for, if we have a bottom 9, we want to make certain the low of 8 or 9 is less than both the lows of 6 and 7. And conversely, at a top where there's a 9, we want to make certain the high of 8 or 9 is above both highs of 6 and 7. Now, the people who write up Bitcoin, I don't think have ever really picked up that nuance, but that's important. Currently, we had a 10 in combo. If you go to the next chart, we had a 13 for a while yesterday at the opening. This is sequential. But there's something else that we've got, and it's included in the charting service that we have. It's something called intersection. We want to make certain that the market is not accelerating to the upside in a setup. If it's a steep move upside, it normally translates into an extended countdown. So what we look for is for the low of either bar 8 or 9 to intersect the low, or the high, I should say, of a bar 3 or more days earlier. Well, that didn't occur until here. So consequently, these two first countdowns, really, it's questionable they exist. Other stock indices only have 10 right now. This one has 12. If you include intersection, you only have 10. But if you used it without intersection, you could have recorded 13 at the open yesterday. And the 13 does appear there. We put an asterisk because of that intersection and because it was recorded at the opening. The next chart is QQQ combo. There's 11. So all this is telling you, in order for combo to progress in the countdown, you have to make successively higher highs and higher closes. So we're not going to record a 12 or a 13 unless we go to new highs above the high 2-3 days ago. So you got to make successfully higher closes. Sequential can meander and move sideways and still accumulate setup countdowns. You don't necessarily need a new high, but there is one restriction. Bar 13 has to exceed the close of 8, just to make it an orthodox price pattern. So we're at 10 there. Most of them are all 10, 11. You know, like if you go forward again. But the one thing that's missing, is that most of the stock indices, surprisingly, didn't record sell setups. The QQQ, the NDX, the SOX index, the OEX, those are the few that did, and they've all progressed to 10 or 11 countdown. The other markets, like IWM, small cap, number of markets did not record 9 sell setups. So they've been underperforming, and the ones that have been performing are the ones that recorded sell setups. This is a 1 minute of today of the E-mini, for example, using this is using combo, and we recommend combo if you're going to trade intraday. But you can see there. No, I'm sorry. This is sequential. But the combination of sequential and combo intraday is very helpful. And what it does, more than anything else, it introduces a level of discipline. Because if you're following combo intraday, you could get emotionally involved in a position. You can follow the news, or you can follow a fellow trader, and you can just follow a whim. This makes every decision requires an unfolding of price in a certain prescribed way. Otherwise, the 13 and 9 won't appear. So it's very helpful that way. Now, this bottom, the histogram on the bottom, you can see that there's the blue acceleration and deceleration. They conform with the setups, and then the red is the countdown. So if you can't see it close up, you can see it through that. There's a diamond associated with the last setup, and it may not be on top of the setup 9. That's because perfection was right there, for example. Excuse me, the market didn't make a high above both sell setup 6 and 7, so it postponed the perfection of the setup. You go forward. Now this is Boeing. I think on TV I made this forecast as well. This is using the same approach, the absolute retracement off the high, and which was the end of February, that peak. And in this particular case, there was no gap downside, but if there had been a gap downside, you would use the next day's close. But for the 62% and the 50 and the 38%, 23.6% was the downside projection. What we like to look for is the confluence of both the absolute retracement, if it's a major turning point, as well as the 13. And that was recorded there, and this one here is this is combo. The next example is sequential. And sequential and combo both are operating together, and what that does, that reinforces the 13. So you would have waited probably for the 13 that you had recorded on the sequential, and it was the exact low. It was a low close, I should say, the low close, or 1 day before the low close. And if you can also introduce what you can do with the charting services, go into different time periods. For example, we like to use not only the daily or weekly, but we like to drill down into the 144 and 89, 55, 34, 21, and 13. Get them all in alignment. When that happens, it's cycle driven then. It's exhaustion, cycle driven, coincidence of all the time periods. And next, this is the Bitcoin where supposedly we've made an impact amongst a lot of the traders. You can see the 13 way back in 2017, 18 was the day of the high, and then the low in December for early January was exactly the low there, and then the other 13. This is all based upon combo. Now, if you include sequential as well, we caught the high back in February, and the recent high as well. But the recent high was in the other coin exchanges. And here's Bitcoin longer term. It's a combination of sequential and combo. And this is the level where most of the writers operate. They trade the 9s. And it's really simple here. The 9s maybe don't appear as large because we've got a smaller chart. We've compressed the chart, but you can see here that the 9s were the turning points, and this is what they use. That's every time you've had 9 closes greater than the close 4 bars earlier, or 9 closes less than the close 4 bars earlier. And once you run a series of 9 of them, then you compare the low of 8 or 9 versus the low of 6 and 7. If you don't have a lower low in 8 and 9 versus 6 and 7, then you just postpone it until you have a lower low, and that's when that dark point would appear on on the histogram. It'll also appear on the chart itself. Now, okay, for those who aren't familiar, I think a number of you are familiar with the construction of sequential and combo. They both have a commonality in the sense that there's a setup required. There's a comparison that's made once you record, but this applies whether it's daily, intraday, 1 minute, 5 minute, or weekly or monthly. Once you have what's called a flip, say for example, the close yesterday is less than the close 4 bars earlier, and then 4 trading days earlier, I should say. And if today's close is greater than the close 4 bars earlier, 4 trading days earlier, that would produce a 1. I'll let Rod go from there.
Thanks, Tom. So you've seen several examples that hopefully whet your appetite, and I mean the followers for these Bitcoin guys that use is important. Correctly vetted code means that it's authenticated. That it's very complicated. In fact, I was told by one of the mathematicians that we have 52,000 different combinations, permutations. The beauty of Tom's work, like we talked about earlier, is what you see is what you get. Once it's on the chart, it's there forever. When you see a 9, it's there. When you see a 13, it's there. It's not going to change. And that's one wonderful thing is that you're no longer looking back at a history that changes, is that you're looking at something and you can anticipate the price inflection points. And so the reason I bring that up is because you saw several examples, and I mentioned Tom had mentioned that Tom Thornton had posted that 13 the other day, and then Bitcoin had dropped to over about 1,200 points based on that sequential 13. This happens all the time in the community, and we were kind of privileged because we have code that is authentic, and it's very important to understand that because the code is so complicated that we want to make sure that what you're looking at is correctly calculated, because if you have, it's garbage in, garbage out. So what I'm going to do is I'm going to quickly describe the details in broad strokes of how we arrive at the coveted 13. The prelude to that is this filter, the 1 through 9. You'll notice that these are consecutive price bars. As Tom mentioned, we need to have a price flip. So if you take a look at this close, it's less than the close 4 price bars ago. We would have seen a green number 1 there. If we just forget the right side of the chart, you would have seen a green 1 there. You would have seen a green 1 above this one, and that's what I mean is what you see is what you get. It's just laying out the facts. Once we establish close greater than the close 4 price bars ago, again, in increments, this has to happen sequentially, one after another. 9 consecutive occurrences, we have what's known as a setup. Once that setup is complete, we have the opportunity to begin counting the countdown phase. And what do we do in this case? We're looking for buyers entering the market. So Tom also mentioned something called setup perfection. We know the vast majority of setups are perfected. What that means is simply, in this case, the high of 8 or 9 has exceeded the reference level set by 6 and 7, the higher of the two in this case. And that's what we call a perfected setup. So you can see that identifies the direction that we're going to count. We have a sell setup in this case. In this case, we have a buy setup, and that's just simply here we have the prerequisite, a close greater than the close 4 price bars ago, followed immediately by a close less than the close 4 price bars ago. When that happens, 9 consecutive occurrences, then we have a buy setup. That buy setup is established. This is what perfection. What we're talking about in this case is we're looking for the low of either 8 or 9 less than the low of 6 and 7. When that happens, we have what's called perfection. And perfection just simply means that configuration is established. If it hasn't been established, then oftentimes the market will revisit that level that's established. It's uncanny how well that operates. Tom mentioned early on, he goes, typically when we have a setup based on the relationship of the TDST, we have a reflex. We have a quick correction in the market. You can look back on any chart and see this. Same thing on the inverse is true. A sell setup is a high of 8 or 9 is greater than the high of 6 and 7. So this is a postponed or an imperfected setup that ultimately was exceeded after, you see where the 8 and 9, that high was not greater than the high of 6 and 7. So we knew that the market had to make a higher high than the reference levels set by 6 and 7. At that point, an arrow appeared, or on the histogram as we saw, a little asterisk, or a little box, anything to indicate that perfection has been established. Very important. Typically a 1 to 4 price bar reaction. However, very important to pay heed to the relationship to the previous TDST level. We're going to get into TDST level here in just a few minutes because it's so important what these underlying setups, once they are established, we draw a reference level to that. And we want to observe the market behavior around that reference level when the market turns. In fact, I was sitting with Tom right at the market high, February 20, 3 days after the 23rd, and we had exceeded, we were doing research in the theater, and Tom looked at the price bar that had exceeded that downside TDST, and he goes, guys, this is not good. He goes, this is not good. I got to get hold of Steve. He left. He got to go talk to some people. And he said, I got to. This is not good. We've exceeded the downside TDST level within 3 price bars. Very significant. What that's suggesting is the current underlying trend is greater in magnitude than the previous underlying trend. I mean, that's the beauty of Tom's work. Happened at the high. When we have a compressed setup, there's an opportunity for the market to demonstrate weakness. Now, it's not over until the fat lady sings. I got to tell you, when there was a couple times, there was one time I was doing a webinar in 2010, April of 2010, and I remember it was right off the lows, and we had started to exceed a shallow setup. And as I'm giving the webinar, I said, look, we got to wait for this 9 to establish, and it was into the close of the day. And sure enough, that price flip happened, the 9 evaporated, and off we went. We rocketed. So it's very important. That's what I love about Tom's work. What you see is what you get. Rules are rules. The breakout qualifiers, we haven't even gotten to that. It's so important. Those are applied to the TDST level. Relative retracement, absolute retracement, a thing called trend factor. I got to move on because there's so much more material to cover. This is the TDST. This is just simply the lowest true low of the sell setup. And all a true low is the current price bar's low or the previous bar's close, whichever the two is less. We're going to, again, use that as a reference. I'm backing up here because imagine a new price bar right after the last price bar on the chart. Imagine that price bar exceeding that TDST level. That's exactly what happened on February 25th. And the magnitude of the current underlying trend, the market's response to that TDST level was so telling that we abruptly ended our research, and that was a prelude to this tremendous market move that Tom just captured with perfection. I mean, you heard Kramer talk about it. God-like predictions. I mean, titans of trading. This stuff isn't doled out by, these are facts. And this is only a sample of what Tom's created. So I'm going to move forward. TDST is the highest true high of the T. The reason this is drawn on the 3 is because it doesn't necessarily happen to be the first price bar of that setup. It can be the third one in this case. It can be whatever. But the point is it's a reference level to the last time the setup was set. Sequential. This is a sequential countdown. So back up to that setup, the setup phase is shared by both combo and sequential. Now, when it comes to sequential and combo, the difference is in the countdown, because that sequential countdown can only begin on or after the 9th price bar. Now, Tom had mentioned something about intersection, and that's just a way to defer it to make sure that we're in the ideal. It's like trying to find a sweet spot, the Goldilocks zone, the ideal, and obsessively trying to decode which 13 is going to be the fat tail. And that's what he's done, and he continues to do. So intersection is just another way. Both combo and sequential arrive at 13s, and they both mean the same thing: potential price exhaustion. Now, combo begins all the way back at the beginning of the setup phase, whereas sequential begins at the end of the setup. They both look for price exhaustion. We're looking for accumulation in this case because the prices are above the price bars. We're looking for the close, which is the opinion of all the buyers, the sellers, the traders, investors. At the end of the day, they reconcile and say, this is what this should be valued at. If it's higher than the highest price, the most optimistic buying 2 price bars ago in this case, then what we have is accumulation. This doesn't have to happen consecutively. All we have to do is have 13 occurrences of this accumulation. Why? Because we're looking for a depletion of buyers entering the market. And the premise is that it's not sophisticated sellers that sell the market high. Everybody's uber confident at the high. Tom sat next to the best traders in the world. He said, everybody's bullish. At the bottom, everybody's scared. He goes, so what we're doing is we're measuring buyers entering the market. And some reason, at the 13th occurrence of this, we're at a potential inflection point. Now, what do we do when we see a 13? We look at price and time. We're going to get into that. It's called the risk level and 12 price bar metric. Beautiful work. All right, moving forward. So sequential, in this case, we did not have a close greater than the high 2 price bars ago. It did not increment. Next price bar, close greater than the high 2 price bars ago, incremented. 13 non-consecutive occurrences, bam, we have 13. The deferral that Tom talked about, that asterisk on there, that's designed to ensure the configuration of the tail of the setup phase has demonstrated exhaustion. That's why you'll have the high of 13 in this case must intersect the close of countdown 8, because conceivably you could have an established sell setup and then sell off the entire time. Every time there's a hiccup in the market, it could increment, and you could conceivably have a 13 at a lower price than the setup. Remember, we're looking for exhaustion of 13s. We're looking for the market to ratchet up and exhaust that, and then we'll stamp the 13. So that's what deferral does. 13 appeared there. The risk level is just simply the maximum amount of buyers that entered the market during the countdown phase, nothing else, just simply reflected on top of that high of the 13. And it says, what this risk level says is it says, okay, we're at a potential exhaustion zone or inflection point, and if the market demonstrates enough strength that we exceed and qualify and confirm that risk level, what we have is renewed buying interest. Same thing in the inverse is true, is that if the market is weak enough that it sells off and qualifies and confirms, it says that line turns solid automatically for you on vetted platforms, i.e. Bloomberg, CQG, Symbolic, all of these levels will turn solid, indicating that it is qualified and confirmed. That would tell you, hey, this 13 may not be that rare fat tail that you're looking for. We had one that appeared just the other day, just like I said on Bitcoin, beautiful. 13 hit, next day, bam. Incidentally, in December 3rd of 2014, after a 4-year decline, the Chinese market, Tom came on and says, well, market's going to rally 48%. They call it the demark drive. Oh, there was a forecast on Apple, too. It cost them $6 billion. These guys, they called it the demark decline. So when in December 3rd, when he made that forecast that it was going to go 48%, the next day on December 4th, it rallied and did not stop until January 13th of 2015, when Tom went back on the air and said, we've reached a 13. I expect about an 11% pullback in the market with 12%. The next consecutive 7 forecast on the Chinese market that they were just, again, just absolutely brilliant. And in fact, we got a Google alert one day. It was the Shanghai Markets paper that had a cover of Tom on the photo at his sports bar. And it said, we translated it, it says, the prophecy emperor has spoken. Sometimes it's just absolutely spooky, uncanny accuracy, precision. That's why these Bitcoin guys are getting so much press. You want to talk about followers. Forecasting with vetted data, very important, vetted code. These guys are, just killing it. With combos, the sequentials and combos and 9s and 13s, it's absolutely, sometimes it's just breathtaking. Like that 1,200 point move in 2 days. So 12 price bars, if you don't move in within 12 price bars, if the market doesn't do anything significant, oftentimes the underlying trend will resume. Next page, that was that Shanghai Securities News that I mentioned, the prophecy emperor has spoken. Here's a few educational examples only. The beauty of Tom's work is that you don't have to change anything about your trading style or your investment style. You just simply overlay the indicators and let them reveal the potential exhaustion. This happened to be an S&P 1-minute chart. You can see how well the 13s, no magic, no eraser, no pencil. This is real time. This is what was produced. I mean, look how good of a job it does filtering out noise in the market. That's one of the greatest things I think about Tom's work is that, you know, it's objective. I mean, half a century of obsessive research have gone into this tool belt, this arsenal of indicators. We've only talked about, let's see, four indicators. And now, granted, these are probably his most famous indicators. However, there is an entire suite of analytics that Tom's created to analyze the markets, and he does oh so well. Take a look at this. Bitcoin. Remember that 13 I talked about just the other day? 1,200 point move. Tommy Thornton nailed it. So here is Bitcoin. Here's a Bitcoin 1-minute chart. Same thing. Beautiful. You see the 9s and 13s. We talked about how these perfections and the turns on the 9s and 13s. Bitcoin 5-minute chart. There's another one with the deferral. Here's Ripple, Bitcoin Cash. Cash, this is a tether. Here's a Bitcoin versus the pound. TransDigm Group with absolute retracement. That's qualified and disqualified state of the projection levels. United Healthcare Group. Right down to that golden ratio, the 61.8% absolute retracement. Home Depot, Carnival Corp, Norwegian Cruise Lines, Norwegian, Sequential, Carnival, Sequential. So many examples. MGM Resorts?
Yeah, the way MGM, Bed Bath & Beyond, a number of the broad indices like the IWM, Russell, and the small cap and mid cap, the way they're behaving, they're not participating like the S&P and the NASDAQ indices. If you look, MGM made a low when there was a 13 at that low. There are quite a few stocks produced 13s the same day we called the market to the bottom at March 23rd. But the response has been so segmented. It's just the technology stocks, the bio stocks, and the NASDAQ and S&P. Otherwise, you get this response. And the same thing, the banks have been that way. But I think today, J.P. Morgan gave it 13. But we go through a few others. You see Bed Bath & Beyond. These big merchandisers, with the exception of Walmart and Amazon, they both worked well with 13s at the bottom, but they responded quite a bit better. There's a small cap index, mid cap index, very lethargic. There's the S&P composite. You can see there, you can see the S&P composite is laboring as well, but the real strong markets are the NASDAQ related. And those are the ones that have confirmed upside breaks to the magnet price. There's three primary levels in retracement, and the way we define retracements is such that we will take an absolute high and then make projections downside, and that absolute high could be substituted with any rally that we've had that's at least 38.2% off the bottom, and then make the projection downside. You know, we can reset it on the way down to get finer projections downside, and by reassessing the supply and demand. A relative retracement will take a low and then go to the last time that you were at a lower low and take the highest price in between. I don't know how many of you used retracements. In the past, you've used maybe Fibonacci numbers or 50%, 1/3, 2/3 retracements, and you'll use it off this high down to the low, that high down to the low, that high. It's so arbitrary. And what we like to do, like I said, is everything we want to make mechanical and totally objective. So we'll take a low and go to the last time this price was below that low and take the highest price in between and calculate the retracements. 38.2% retracement is approximately here, and the 50% straight, or 62% turned out to be right here. If we project it off of here, you saw in an earlier chart it was there, and the 50% was here, which we don't include on the chart. But if we're able to break the 62% by a qualified break, what we call qualified, and then a confirmed follow through the next bar, we could go all the way back up here, but we have no indication of that right now. What's next? You can see there's the S&P 1500. I mean, you recovered 50%. You recovered 50% into the September-October decline 1929. You rallied in April of 1930, 56%. So you got those rallies, but it's still better than what the broader markets, the mid-cap, small-cap, and Russell have done. Here's Facebook. Currently it's a 12, just to give you some perspective on current markets. That's a 12 sequential and combo. It's 11 there. Apple's only a 9 countdown, both sequential and combo. Microsoft's a 9. So that's countdown. You're seeing what you're getting here. You had a 9 sell setup, but you're below the TDST, which is the inception, the highest price of a 9 downside. We were below it, so I'm sorry, we were above it. It occurred here. It told you your decline would probably be modest, and it was. 2 days, the same thing here. And now we're looking for 10, 11, 12, 13. Ideally, when we can identify the exhaustion on the upside. We go forward, these are the big names. These are the ones that had the biggest move. And there's JP Morgan I was talking about. I think it produced a 13 today, I'm not certain, but you can see that here. JP Morgan, we've had these asterisks here. The reason they're asterisks is because the low of 13 must exceed the close of countdown 8. And throughout this period, there's a 13, but that qualifier was not fulfilled. Same thing here, same thing there. And finally here, it did exceed the close of 8. And that's totally, that's one qualifier. We also use another qualifier to fine tune it further. We look for the close of 8 to exceed the close of 5. There would have been a 8 here, 8 here. But that's something we use internally. And now, Wells Fargo, look how labored this rally was. You know, whereas the technology stocks, Facebook and the other ones, Amazon, they all did well. And the biotech stocks as well. Now we're currently at 913.9. We've got a 13 here, but we got an extension of another 9 there, and that's the response. Here, Brad was talking about earlier, the TDST was here, for example. We don't have it shown here, but there's a 9 up into this peak. Because we broke the TDST and we confirmed the break, we knew that this 9 would be very short term. And we knew it was just a brief short covering rally for 1 or 2 days, and we were moving toward 13. There's Wells Fargo, same thing, sequential and combo. This one's combo. Now, the way we can tell if sequential or combo, like Rod said earlier, they both start with a 9 setup. But combo goes all the way back to the setup and starts to count down there. It's more rigid than sequential. Sequential only requires, once you've recorded a 9, you compare, for example, here, the close. Once you recorded a setup, you compare the close with the low 2 bars earlier. And once you recorded 13 of them, now you have to have the other rules as well. 13 had a low of 13 less than the close of 8. And you can't what we call recycle, but regardless, you can see here, this one is combo. We started the countdown on bar 1. We compare the close versus the low 2 bars earlier, the same as we do with sequential, but sequential doesn't start the count until here. But each countdown is more rigid. You have to be successively lower. The closes have to be successfully lower. The lows have to be successfully lower. So there's about 4 or 5 rules that are incorporated into it. So everything is in the chart itself. We don't make any subjective, we don't draw any subjective conclusions. Everything is rigid. There are about 80 indicators that we monitor. We're able to, with our software now, we're able to construct, we're able to do searches, we're able to do alerts, or they're about ready to release alerts. I think Rod could probably help us more.
Yeah, there's a lot of great features that are available on the charting platform, and this is the demark. This is the platform that we've been showcasing today. That has the all of the calculations, everything demark fully functional on cloud-based computing, which allows it to be distributed not only from your personal computer, but to any mobile devices like the iPad or iPhone. So, at this time, I'd just like to see, are there any questions that have come in? Steve, are you there?
I am, and yes, we do have a few questions here. Just one moment. What is the difference between aggressive sequential and sequential?
Yeah, great question. Whoever wrote that, what you're going to see is the countdown is the only thing that's different here. We're just simply, remember when I said we're looking for accumulation when the numbers are above the price bar? And we're comparing the closing price, which is the opinions of all the buyers, sellers, traders, and investors that day, compared to the high 2 price bars ago, which was the most aggressive buying. So we're going to throw that out. We're going to simply compare the high, the most aggressive high price activity compared to the high 2 price bars ago. And when that happens 13 non-consecutive times, we have an aggressive 13 countdown.
So instead of comparing the close versus the high or low 2 bars earlier, the high or low itself is compared. So you compare the low, for example, versus the low 2 bars earlier, instead of the close versus the low 2 bars earlier. In a sense, it's more aggressive. The 13s appear earlier, and the market, sometimes you don't record a 13. Like one of the examples we showed just before with the NASDAQ composite yesterday, assuming that was a high, or 2 days ago, at the opening we had a 13. The aggressive sequential or aggressive combo would have recorded that, because all you had to do is make the high greater than the high 2 bars earlier, and as long as they're successively higher and they've got the other rules that are inclusive in combo, you'll have 13s. And like I said, they appear earlier. Some people want to anticipate the tops and bottoms, so all we've done is just substitute the close of any particular price bar with its high or low. So that's the distinction.
Excellent, thank you. Next question is the demarker oscillator. Can you please explain that, and is it available on Symbolic?
It's all the indicators, all the major indicators are included there. The marker, back in the 1970s, there were very few oscillators. When I started in the business, there weren't any, to be honest with you. There was only trend lines, and I'm trying to think, trend lines, Elliott wave, which really hadn't been uncovered or discovered. It was in the New York Library, and I was the one who retrieved it from the library in 1972. It was in the archives, Nature's Law of Financial World publication. And most people just used trend lines and moving averages, and that was it. There really was nothing else. We didn't have computers back then. There was a Beaumark calculator, which I used, proportional divider and things like that. And then I got to know a fellow by the name of Wells Wilder very, very well. And he was an engineer, and he was working on a few indicators. And I've helped him out back then, and that is the relative strength index. It's really not a relative strength index. It's in the sense that it's an oscillator, but it's a misnomer. It's an oscillator constructed based upon successive price bars. That was around in 1977. There was Larry Williams. Well, there was percent D and a percent R. That's stochastics. A fellow by the name of Ralph Distant, who was a dentist in Chicago, whom I worked with as well, peripherally. He created that, and then Larry did some work on oscillators. He created something called percent R, which is simultaneously with the Ralph Distant's work, and it's really the inverse. what I did with demarker, for example, is take the trend, but instead of normalizing like most people do, they take successive price bars and they compare the close versus the close of one versus the other. And some of the people do it exponentially, and that's how they construct their oscillators. I wanted something that was more established, and we've got three main oscillators. REI is exceptionally good. I mean, it's just this indicator is phenomenal. The REI indicator that lags. Most of our work anticipates. Unfortunately, REI lags. The demarker 1 and demarker 2. Demarker 1 takes the high of the current price bar and compares it with the high 2 price bars earlier. So that by ignoring the prior price bar, you can really establish the trend. It takes the high versus high and low versus low. And demarker 2 takes the high versus the prior bar's close and the low versus prior bar's close and constructs a buying and selling type of comparison. And with the symbolic, the explanations in there, I'm sure it's a little complicated to go through this right now. But the big distinction in demarker versus conventional oscillators is instead of comparing one price bar versus the prior one, it's current versus 2 ago, and then you just make it cumulative. And you can do it for different time periods. That is more anticipatory as well. And then if you apply, if you run an 8 or a 13 moving average on it, you can run a 3-day moving average, and once that breaks out to the upside or downside, and you're below 30 or above 70, you get good entry points for the market. But once again, it's a little lagging. So I hope that answers the question.
Thank you. Does this have any link to Elliott wave theory?
Yeah, all of it does. I mean, we also got D-wave, what's called D-wave. Elliott wave, Bob Prechter, I knew back in the 1970s. In fact, the fellow who was in charge of Merrill Lynch technical department, there were about 13 or 14 people in that department. So we have Bob Farrell, and his sidekick was Dick McCabe. Once I retrieved the Elliott wave forecast treatise from 1946 at the New York Library, I gave it to both of them, and they passed it all the way down to their technical team. And Bob Prechter was one of the people who received it, and he made a profession out of it. He had a phenomenal call in 1987. But the problem is he's the professor, and the student, it's somewhat subjective. You've got 3 waves up, 5 waves up, and with 3 intervening declines. What we've done, we've taken Elliott wave, and we call it D wave. We've made it totally objective. We said before you can start a wave move to the upside, you have to have a 21 bar low, not 21 days, 21 weeks, whatever, however you want to identify it. And the first subsequent high that's above the prior 8 highs is your first move up. And that can extend. It could be an 8-day high, 9-day, 10-day, 11, 12. As long as those highs keep making higher highs, you've got the first wave. Once you decline, which is 62% of 8 days, which is 5, and make a low less than the prior 4 lows, then you got the first wave completed. Now that first wave, like I said, won't necessarily stop at 8. It could go to 20. And then once you have a 5-bar retracement where you make the low less than the prior 4 bars lows, you've got your first wave upside. And then your next wave upside, because the first one is an 8 and a 5, next one is a 13, and then the reaction's 8, and the final one's 21 again. But you can take the ratios, which are included in their indicators, and you can take 161.8% times the first move up, or 261.8%, and you get upside price objectives. And someone told me, I wasn't following it, but into that low at the end of March 23rd, the downside projection of 361.8% was fulfilled right there at the day of the low. So yes, we do have it. It's totally rigid and mechanical. So you'll see it on a chart. If a projection is made, you'll see it there. It's permanently there, and the waves are labeled. So there's no subjectivity involved.
Excellent. What is the name of the setup oscillator that had diamonds on the bottom of your charts today?
That's called perfection. For a 9 setup, once you've accumulated 9 consecutive closes greater than the close 4 bars earlier, or 9 consecutive closes less than the close 4 bars earlier, provided the low of bar 8 or bar 9 is less than both 6 and 7, provided that occurs, you will have a perfected setup. And once the perfected setup appears, you'll see an arrow on the chart, which we didn't include on the chart itself, but on the histogram you'll see a diamond. And if it's postponed for some reason, the low of 8 or 9 is not less than both 6 and 7, it could occur the following day. It doesn't have to be part of the setup, but ultimately, ideally, you'll make a lower low than those 6 and 7 lows, and that's where the diamond will appear.
Just so you know, the oscillator was not anything different. It was just a different display parameter. It's embedded in sequential and combo. It's known as a histogram.
Yeah, but you don't have to include it. Some people like the numbers. Some people like to see it visually with a histogram. And the reason we had the histogram included is because visually, in case you couldn't see the numbers, that would become apparent. But you can do both. We do both. It does give a good feel. You can see that the frequency of the 9s, you can see the frequencies of 13s, you can see them displayed beneath the chart. And I find it helpful.
Thank you. Do you think we'll retest the March 23rd lows?
I'll tell you, what happened, when Kramer was on TV, I sent him a model, and I said, this market is just like 2011. Everybody was comparing it to 1987. They were comparing it to 1929. And what I found, into that peak, there were 14, I can go through all this with you, but there were 14 trading days into the peak for the current market. That was the only difference between the current market and the market in 2011. In 2011, we made the peak, and we had a 11-day rally, but both declines were 21 days. Both declines, well, the decline in 2011 was 19%. This one was double. We had sets where if you take the number of consecutive down closes and you treat that as one bar, we call it a demark bar. So if you have 3 down closes, we'll create a bar, we'll call it a demark bar, and it's really only one bar. And then if we have because we have a rally, if we have a one-day closing rally, then we start again. There were 7 sets of declines, consecutive days declines, in 2011 into the low August 9th. And there were 7 consecutive into the low March 23rd. The rallies, I mean, it was unbelievable that they were both in lockstep up until just about the middle of April. The rally off the low in 2011 the first rally was 11.2%, which is something called the trend factor. If you take 5.56%, multiply it times 2, you'll get 11.2%. That's what we use. But you talked about Elliott. Elliott is really a derivative of Fibonacci, and if you take 61.8% divided by, or subtract from that 38.2%, you get 23.6%. If you divide that by 4, you get 0.059%. That's the way the market pulses. It has impulses, but we fine-tuned that better 40 years ago. It's really 0.0556, and that's what we call trend factor. But that's the way the market, off the low, I looked for 11.2% rally. We got it in 2 days. But that equivalent in the low the rally, current rally, was really double that. It was 23.2%, whereas in 2011 it was 11.2. I take it back, 22.4%, and currently back then it was 11.2. So everything was double. Then all of a sudden, right about April 13th, it decoupled. So, but I was looking for the market just to move sideways, and we get the sequential 13, and it just didn't happen. But you got to adjust. Usually, I mean, currently the market right now looks like 1973. It looks like we're looking at this today. The rally off the decline in 1973 from the Vietnam peace in January 21st. It was 1067 on the Dow and went down close to 800. That decline was 19%. We declined 38%. Then the rally off that low into the energy crisis in late October of 1973, October, November, December. That rally was 62%. We went above 62%. We're right above 62% right now. So one more move up would make the two pretty much. It would make them pretty similar. But everything, you could build an analog anywhere you want. Back in 1987, I compared 1929 to it. We made the high on August 24th, I think it was 1987, And the market, if you took the overlay with 1929, they were identical. Same number of days in decline and everything. But too many people are looking at this nowadays. At the low on March 23rd, I started promoting the fact, not promoting in a sense, but talking about the comparison between 2011, and I think it just got too pedestrian. It's too common. And then you got the disparity between the technology and the biotech stocks versus the general market. I mean, it's really 5 or 6 stocks have carried the market. You know, Amazon, Facebook, you know, the names, you know, that the big names are the ones that have moved it. You know, that's it. And you look at the average stock, it hasn't done anything. So are we going to do are we going to make a new low? Almost hope not, but it looks like it could. I'm not making any forecasts. We're not, our attorneys and staff won't allow me to make any forecasts, but it's beginning to look like those 5 stocks. If you took those out of the index, the market would be nowhere where it is right now. You know, we'd be looking like J.P. Morgan or something, that stock.
Thanks, Tom. Do you have a simple newsletter or buy, hold, sell service?
No service at all. Just the only thing we've got, and we did this for internally, we spent